Good afternoon, everyone, and a very, very warm welcome once again to Talos Institutional Day here at our brand new APAC headquarters, just recently inaugurated. My name is Rashu Jindel. I am a sales director here at Talos. Please do feel free to connect with us later on. And as Samar said, feel free to catch any one of us if you would like a tour of the rest of the office. It is my pleasure to be sharing a stage with these distinguished panelists over here. So without further ado, if I can request, gentlemen, for you to introduce yourselves, and then we can kick things off.
Thanks, Rash. My name's Michael Prendiville. I'm the CEO of Jelly Sea. A little bit about Jelly Sea. We're an investment management business in Australia, Singapore, Bahamas. We have two Cayman's funds for Australian unit trusts. We have a direct investment into Australia's first licensed and regulated stablecoin, Katina.
I'm Darius. I'm the founder of QCP. We are Asia's leading digital asset trading partner. We help clients with investment and hedging solutions in digital assets.
My name is Shiliang Tang. I'm the managing partner of Monarq Asset Management. We are a multi-strategy crypto hedge fund.
Cool. So thank you very much, guys, for that. Now, in terms of the topic today, so we've called it digital asset allocation and strategy. And for the first question, I just want you guys to sort of take yourselves back, say, 18 to 24 months, right? If someone asked about digital asset allocation strategy back then versus now, we know there's been a seismic shift in terms of institutions allocating to digital assets. So my first question to you, and please feel free to put up your hand, is why allocate now? And why is it different now as opposed to 18 months ago? Anyone, please. Michael, go for it.
Yeah, I'll start. Well, I guess January of 2024 was a digital moment when the SEC approved Bitcoin ETFs, and then, the Ethereum ETFs came after. That opened up everything for I guess the whole ecosystem. With BlackRock, IBIT coming through, it really sort of got the retail, it got the wholesale, and it got the institutions in America coming through. Now, I'm sort of differentiating here, America versus the rest of the world, because I'm based in Australia. We still have not had the institutions, we haven't had the wealth managers open up. So we've got draft legislation going through there, but it's going to take, say, the second half of next year before that happens. The Genius Act with Donald Trump and the qualifying everything over there on the stablecoin side, Clarity Act, that's having ripple effects into Australia, and I'm sure it's having an impact in every country around the world. Okay, and so that is the impetus that's getting us going on the Australian side, and I'd say that we're really excited. For instance, for Jelly Sea, we're positioning ourselves in the institutional space. Yeah. So when everything opens up, we're the safe pair of hands for people to be able to invest. But it is exciting. There's a lot going on, and we're sort of we're really motoring on.
I'll add to what Michael said. So I agree. First thing was the ETFs. That brought Bitcoin and digital assets from alternative allocation to necessary allocation, right? The second trigger, I think, or second watershed moment was Trump talking about a strategic reserve. Because so with that statement, suddenly every country is thinking about whether I should have that as well. And then we start to have conversations with sovereign states about Bitcoin. You pinch yourself a little bit because I didn't think we'd be having those conversations so soon. And Michael also mentioned the Genius Act, which I think there's a lot more implications than what it seems in just a stablecoin act. Because what happened, I think, was that digital assets became a geopolitical issue, right? Meaning that the dollar is being weaponized effectively in a new arena for currency war. And then, you have big bulge bracket banks coming to our office and wanting to onboard us. Again, pinching ourselves, not thinking we would be getting those conversations so soon. So things really accelerated in the last couple of years. So it became, in the last couple of years, our clientele makeup changed as well, right? So it went from very native, high net worth, and you start talking to governments, corporates, listed companies, And I think that wave continues and accelerates in the next couple of years as well. So if to answer the question, why allocate now? I don't think we're at the end of this institutionalization process. We're probably still at quite at the beginning stages of it.
You know, just quickly add, I think completely agree with what both other panelists said, but it's become, previously it was career risk, at least this is from a US perspective, career risk to allocate to crypto and be affected by all the various things that happened in 2022, 2023. Now I think it's career risk to not allocate to crypto in the US to a certain extent, right? Given all the developments, especially from Washington, DC. So now, even as a fund, we're having a lot more conversations with public companies, for example, right? Or endowments, institutions that previously were very slow to move and wary of the risk with crypto. And now I think the kind of regulatory regime has completely shifted and changed that completely, right? So.
Darius, I want to touch on something that you brought up earlier about your clientele shifting, right? So you mentioned that you have to pinch yourself, and there's a lot of these sovereign states and wealth funds coming and talking to you about crypto. I'm curious to understand, like, when a hedge fund wants to get into crypto versus when a sovereign wealth fund wants to get into crypto, what are the sort of different criteria that the sovereign wealth fund is looking like? I think for a hedge fund, most of us would know, but feel free to dive into that as well. But I think I'm really keen to know what a sovereign wealth fund is asking you before making their first digital asset purchase.
Sounds like a trick question. I think, when a hedge fund, so early days when you have hedge funds, they were the more, let's say 2017 to 2020, hedge funds were probably the more institutional of the stack, right? So they come and they start asking you questions that the natives don't ask you. So onboarding is more challenging. They want to make sure that your credit, you have credit risk mitigation. I think when it moves on to sovereign conversations, it starts to become a regulatory in nature, right? So beyond having risk management and beyond knowing how you manage where your offices are, where your people are, it becomes a regulatory consideration, and then it becomes an infrastructure thing as well. So I think demonstrating that you have proper wallet management, that you have cybersecurity, that you're regulated, these become very, very important things. So for example, we have like 150 people. A lot of that is cybersecurity, compliance, ops, wallet management guys. So I think it becomes a lot heavier in terms of the requirements.
You wanted to add something to that, Michael?
Yeah, just want to make a quick comment. I think there was a change in our customer base pretty much after 2022 when FTX, Celsius, Voyager went under, and the industry had to solve counterparty risk. And so we came up with Clearloop, Copper Clearloop, and Fireblocks off exchange. And at that point, that was when we were able to attract a more institutional type of client, not quite, the likes of Big Super or the Future Fund type thing in Australia, but bordering on that type of client. So then there was obviously in the US the ETF. So
I'm glad you mentioned the supers in Australia. How far do you think we are from superannuation of Victoria coming into digital assets?
Yes, it has to be a regulated environment. We met with the Future Fund a couple of weeks ago. They are very interested in the space, but they will not engage until there's a regulated environment. So that would be custody, that would be exchanges, and then that would be advisors being able to advise on crypto, and there's a couple other elements in there as well. But pretty much in Australia, there's about 4 elements that need to be ticked off for them to be able to get comfort. Also, insurance for wealth managers is an issue there. Yeah. For the big supers, they are reluctant to get involved for 2 reasons. One is regulation. The other one is benchmark issues. So in Australia, a big super has to beat the benchmark. Okay, so they don't have Bitcoin as a benchmark. They don't have Ethereum. You can imagine, we have an infrastructure fund which we try to exceed Ethereum. That would be something we would pitch to them. So we're going to beat Ethereum. Here's your, for the alts, here's that. So we need benchmarks there as well.
Okay, so that gives us a sense of, I guess, what the hurdles are to institutional adoption in a country like Australia, where regulation isn't necessarily clear, fully clear. But Shiliang, if I can just sort of divert it to you, where in the US, where we do have, I would say, some sort of regulatory clarity, right? What do you think are the main obstacles holding back institutions in the US from getting into this space? I mean, I'm sure there are very few left that are truly not thinking about it, but what would you say is the main impediment?
I mean, there's a few impediments, right? I think I mean, to a certain extent, like just again, like education and understanding like the infrastructure. Like infrastructure for crypto is just completely different in terms of like engagement with like prime brokers, right? Like crypto prime brokers are not like true traditional market like prime brokers, like very, very different, right? Like, and people use in the space like use the term very loosely, and it's not like true. Another example is just like even DeFi, right? Yes, there's regulatory clarity, but there's still not a lot of regulatory clarity in DeFi in the US, right? Like for example, one of our investors, like McKinsey Investment Office, right? They're a large private investment firm for like, you know, McKinsey, like consulting firm. Like we had to carve out a piece of our portfolio where we can't touch DeFi, and it's not that they're afraid of DeFi, it's just they can't touch their assets cannot be commingled with, you know, potential capital, you know, within the DeFi ecosystem that has, you know, previously touched whatever terrorist states or something, right? So that's like the kind of worry that is still preventing a lot of very traditional regulated assets, at least in the US, coming to, you know, or allocating, you know, to crypto, right? So yes, there's way more regulatory clarity than there ever was, but there's still a lot that is holding back like regulated institutions in the US.
Okay. If I can sort of move the discussion to a slightly different tangent, I think, Darius, you mentioned a little while ago about the importance of infrastructure as well in terms of trading crypto itself. Once institutions have made the decision that we need to allocate, I think the next natural question for them is, how do we allocate? So it's not a matter of like running a Bloomberg ticker for Bitcoin. I mean, there is a Bloomberg ticker for Bitcoin. It's BTC USD, CRNCY. I don't know why I know that. But how would an institution actually do its first trade in crypto? What do they have to look out for? What are the criteria? How do they get into the big bad space?
The easiest way to trade with institutions is to match whatever they're already doing.
Or use Talos?
Absolutely, of course. But I mean, I used to be from TradFi myself, so you know, you trade FX in a certain way, you have APIs in a certain way. Then when I jumped to crypto 8 years ago, suddenly the entire stack is like upside down, right? You know, good in a way because you know it sort of evens the playing field, and you know you don't have all the HFT guys in yet. But if you want to connect with guys that you used to trade with, they're going to ask for the same things that they asked the banks. They're going to ask for the same things that they asked all the service providers back then. So you know all the tech stack needs to match up. So I think that is very rapidly changing. And we value our partnership with Talos because when we started in the crypto space, we're like, okay, all this, you know, bank tech is not going to be relevant. You know, we focus more on OTC, and suddenly now we find ourselves having to play catch up. You guys become an easy solution for us to play catch up. So I think that's probably the short answer.
Michael?
First thing we would look at would be custody. We want to make sure our assets are safe. Okay, before we do anything else, before we look at returns or anything, we want to make sure that we don't lose our money. And if we go to big super or institutions, we've ticked all the boxes. Okay, so for us, we have a custodial software in Fireblocks. We also have a custodian, okay, in Standard Chartered. Okay, and our assets within Standard Chartered are segregated. So Standard Chartered goes under, we're still good to go. Okay, that would be the first thing. Then in terms of executing, I would definitely have an aggregator, and we've done the rounds on the aggregators around the world, and you know, like the gentleman here, Darius, etc. We know because we come from traditional finance what a good aggregator is. That's why I'm here, because we use Talos, and it's very good, and it's got a lot of fantastic functionality. And as an asset manager, we use it for executing, you know, whether it be you know, funding or basis trades or, you know, just pure spot or, you know, on the derivative side. We're about to go into a new phase where we're going to use Talos on the price making side. Okay, so we'll use their engine. Karen's here somewhere, so my best mate. Anyway, we're about to use their engine and feed into all the exchanges with the Aussie stablecoin that we mentioned earlier. Okay, so we're going that next phase. We hope, I said that we hope to be celebrating with some champagne the next time we come in because we're doing so much volume. So that's kind of where we're at.
That sounds highly, highly encouraging, so I'm very glad you said that. He was referring to Karan, by the way, who's our head of account management in APAC. Highly recommend you guys find him somewhere in the crowd and speak to him. Absolutely lovely guy. If I can sort of move this on towards our sort of closing comments, right? This is something that a lot of speakers, myself included, typically don't want to comment on, but I'll ask anyway. Big, bold prediction for our industry. I wouldn't say 5 years from now, because God knows what's going to happen in 5 years from now, but let's say 1 year from now, from each of you. I know Michael's involves a lot of champagne, which is great, but let's get to some more sort of crypto related. Go for it, Mike. Anyway.
Can I go a little bit further out? Do you
Of
mind?
course.
Sorry,
Further out, sure.
One is too narrow for me. I see a moment, I see a time where all transactions going through the blockchain. Okay, and then that sort of feeds through everything. That feeds to, Ethereum going to 40,000, that's Solana over 1,000, et cetera, et cetera. So, all the merchant transactions, all of the real world assets, et cetera, all going through the blockchain. The average person in the street being able to make his payments with the stablecoin, not pay any fees, to be able to transact on the FX side, not pay any fees, to be able to one click into not just a traditional bank account, deposit, but one click into an account that's giving you the best of traditional yields and crypto yields. I just make, like Athena, for instance, one click in, one click out, using your payments like that. For me, it's a really exciting future, and that's kind of what we see.
It's interesting because one of the core beliefs of our founders, Anton and Ethan as well, when they founded the company, was that eventually all assets will trade on digital asset rails. Please, Darius.
So the Straits Times asked me this question recently. So they were like, do you think Bitcoin will hit 250K in 1 year's time? So my tongue-in-cheek answer was, your question is wrong. Because in 1 year's time, we'll be measuring other assets in Bitcoin terms. They didn't publish that, by the way. So.
Neither will we, don't worry.
But my real answer is this, and it's a bit more boring. I think Bitcoin will stop being a novel asset. Right now we see it as something novel. It's part of allocation. We'll talk about it that way. I think it would become the cheapest, recognized as Bitcoin, along with stablecoins, tokenized money market funds, will become recognized as cheapest and fastest to deliver collateral for margin trading purposes, for credit purposes, and in that sense, it will just become very, very normal to be using digital assets as for all kinds of financial market reasons, other than speculating as well.
I think for me, like one big question, and this is very more US-centric view or question, is this environment in the US at least is very, whatever you want to call it, like deregulation or regulatory clarity. It does open the floodgates for immense competition, right? And what we're kind of seeing, and one question I'm asking myself is who is the ultimate winner? Is it going to be crypto native firms and exchanges, or is it going to be like a Robinhood, right? Like, can they ultimately create a better experience for the individual user? Because you're already using an app like Robinhood or E-Trade, whatever, to trade everything else, and they just have to tack on crypto, right? And they have an immensely bigger access to bigger balance sheets and for traditional banks, investment banks, and prime brokers, which is something that crypto has always lacked, and it's playing catch up to. So can enough assets come on chain, then you're trading stocks on chain, or will digital assets move, call it either off chain or not necessarily off chain, but go and on an app like Robinhood, and users actually engage in crypto on a app like Robinhood instead, right? So I think that's a big question. I think every day I'm kind of like going back and forth. I think I'm leaning more on the Robinhood crowd, to be honest. But yeah, we'll see.
Cool. I'm certain. I definitely think everyone in this room wants all those predictions, including the 250K one, to come true. So thank you very much for that, guys. Really appreciate your insights today. For the rest of you, this was our Buyside panel on digital asset allocation and strategies. We've got one more, which is going to be led by Pam, who's our head of sales for APAC. So I highly encourage all of you to stay for that. And then there'll be food after that. So thank you very much, guys. Thank you.